Your retirement savings are about to face a seismic shift, and it's all thanks to a bold move by President Trump. Imagine your 401k venturing into the uncharted territories of crypto and private equity. Exciting, right? But here's where it gets controversial. In a recent executive order, President Trump has proposed a radical change to retirement investments, aiming to democratize the way Americans save for their golden years. The plan? To allow 401ks to dive into the world of alternative investments, such as private equity and cryptocurrencies, which have traditionally been off limits for these accounts. This move could potentially revolutionize the $5 trillion private equity industry, which has long sought access to America's retirement savings. And this is the part most people miss. While this shift might sound appealing, offering protection from market volatility and the allure of substantial returns, it's not without its pitfalls. Experts warn that these alternative investments often come with higher risks and less transparency compared to traditional stocks and bonds. For instance, private equity investments are in non-publicly traded companies, making it challenging to track their performance daily. Cryptocurrencies, on the other hand, are known for their wild price swings, despite their growing popularity, with nearly 25% of people now investing in crypto, according to Security.org. The executive order instructs the Labor Department to redefine what constitutes a qualified asset under 401k rules, which are currently governed by the Employee Retirement Income Security Act of 1974, ERISA. This law mandates that employers offer retirement options in their employees' best interests, not Wall Street's. Traditionally, most retirement plans consist of stocks, bonds, and occasionally cash or commodities like gold. But will this change actually benefit the average investor? Employees will still have the option to stick with traditional assets, and they can choose whether to include these new alternative strategies in their portfolios. However, the adoption of these changes may be slow. The complexity of ERISA means it could take months, if not years, for these new investment options to become available. After the Labor Department issues its guidance, retirement plan giants like Fidelity and Vanguard will need time to create suitable funds, and employers will likely require additional time to update their retirement plan offerings. PitchBook analysts predict a sluggish adoption due to the costs, lack of transparency, and complexity associated with these alternative investments. For example, private equity investments often involve higher fees for fund managers, which can significantly reduce overall returns. As PitchBook explains, higher costs come from the fact that while you can trade a stock for pennies, it requires travel, negotiations, legal work, and much more to buy and operate a private company. These costs are typically passed along to fund investors. So, do alternative investments really outperform traditional stocks and bonds? The answer is not straightforward. While they can deliver impressive returns, there's no guarantee. Bitcoin, for instance, soared 135% in value last year, outpacing the S&P 500's 24% growth. However, in 2022, Bitcoin plummeted 65% compared to the S&P 500's 19% decline. Private equity, on the other hand, has shown more consistent long-term performance, with a 13.5% return over a decade, surpassing stocks 9.7% and bonds 1.9%, according to a recent study by the Investment Council. Here's the burning question. Are you ready to take the leap into these uncharted investment waters? As the debate heats up, we want to hear from you. Do you think this move will empower individual investors, or is it a risky gamble with your retirement savings? Share your thoughts in the comments below, and let's spark a conversation that could shape the future of retirement investing.